All right, so learning objective three gives you an idea of why or what the rules are regarding the financial reporting. As we talked about earlier, the balance sheet has a specific structure, right? And that's why it's classified, and that's why there's sort of a pecking order for what accounts go first, second, third, what have you. The income statement has a certain structure, and so forth and so on. These are all part of reporting standards that are the rules that accountants use in financial accounting that we call GAAP. GAAP is generally accepted accounting principles, and these are the rules and practices of the profession. Now, what profession are we talking about? We're talking about financial accounting. Okay. CPAs are experts in financial accounting. And how do these rules get made? How the GAAP get made? Well, strangely enough, accounting is one of many professions that are, in essence, self policing or self regulating. They have an enormous say in how the rules get set up. They are the ones who structure GAAP through what they have as a financial accounting standards board, a group of accountants that represented CPAs that discuss and study and do all types of things to come up with how things should be done, how the app should be created. Now, because we are talking about financial statements that public companies have to do, which means any company that has a stock on the stock market is public. Those reporting, they have to report to the SEC, the government. The Securities Exchange Commission is part of the federal government commission that regulates the stock market and the other securities markets and require financial disclosure, financial reporting. So they do have a say in how all this is done, because it's important that everyone has the same standard. Okay, everyone follows the same set of rules. Okay. Now, the United States is almost alone in its use of GAAP. Most of the world uses a system called the International Financial Reporting Standards, or IFRS. These are the accounting rules and practices for most corporations around the world. And the International Accounting Standards Board are the group of accountants that put together the rules that set up IFRS, just like the Financial Accounting Standards Board is the accounting group that sets up the rules for GAAP. Okay, so that's how those are all created. But you do have to know what GAAP is. You have to definitely know the definition. You're going to be learning all about it through the course, so you are getting introduced to various principles and concepts as we go through the course. So accounting information has to be useful information. And so we have what we call two fundamental qualities for useful information. First, it has to be relevant. Okay, accounting information, meaning it has to make an impact on decision making. That's how we can say something is useful. The other way we look at it is something has to be faithfully represented, which means it has to be complete. It has to be without error. It also has to be presented neutral, right, without bias. And so it's very important that those two fundamental qualities be present before we can use it as information in accounting. Other types of qualities that we call enhancing qualities in accounting means that when we are setting up these forms and setting up the rules, we understand that every company is using the same accounting principles, which is why they set up GAAP in the first place. These are the principles that everyone has to follow. And so we sort of understand each other. Everything is understandable. I mean, it's almost like you think about soccer. You might have a Brazilian team playing a German team in the World Cup with referees and umpires or whatever from Japan. Well, they all know the same rules of the game, so it doesn't really matter where they're from. They all can get together and play the game. That's basically what GAAP is trying to do with all these companies around the United States. Is these are the rules on how we report, so everyone's on the same page. And we know that because anybody can go in, an independent accountant can go in and see whether these other companies are following the rules, right? Which is why if the officials from Japan got sick and couldn't referee the game between Brazil and Germany, we can get referees from South Africa or some other place, right, to do it, because they independently, we all kind of know the rules, so we kind of can verify it. So this is very true. Information used in accounting needs to be documented, needs to be verified. They all need to have the same methods and procedures. Everything has to be set up in the same clear and fashion, which is understandability, which is why we are learning about the classified balance sheet. Right? There's a certain way it needs to be presented. That those are parts of the rules. Companies should be using the same accounting methods year to year to year. That's consistency. And of course, all information needs to be timely. There are four major assumptions that is used when we actually put together all these financial reports and financial statements. One is that we're all using the same money. Remember, corporations are global, so they're selling products in all parts of the world. So when you're selling, when Coca-Cola is selling Coca-Cola in Mexico, they're collecting pesos, right? Well, this monetary unit assumption says that actually when they report financial reporting, everything has to be in US dollars. And so regardless where they're selling Coke, and Coke is sold all over the world, all those sales, all that money has to be, in essence, converted to US dollars when they do their financial reports. Economic entity simply means that everything needs to be separately identified and accounted for. And this usually is a case where, for example, if you had a small business, you would need to keep your personal records separate from your business records, right? Because technically they're two separate things. And this is basically what we think in financial reporting, is that we should be keeping those records specific to the entity and not commingled with others and confused. A couple of others. One that's extremely important, you're going to be reading a lot about in the upcoming chapters, is the periodicity assumption. And that basically is that life of the company, of every company, is divided into time periods. And the time periods are monthly, quarterly. A quarter is a 3-month period of time, and yearly, right? A 12-month period of time. So you're going to learn a lot more about that, but these are really, really important measures. Matter of fact, when you looked at the income statement, right, when you looked at the retained earnings statement, they measured a period of time. That's the periodicity assumption is critically important to those statements. And lastly, there's something called a going concern. We're basically going to be thinking that this business is going to be existing for a long time, well into the future. So, Henry Ford might have started Ford Motor Company, but he's been pushing up daisies for years now. Ford Motor Company is still alive and well. Walt Disney probably wouldn't recognize his company today. It's so much bigger. But Walt Disney, whether you think he's dead, frozen, whatever, I don't know, what are they going to do? Defrost him when the time comes. Basically speaking, Disney is still alive and well and continues to be a going concern, and that's basically what that assumption means. We're not thinking any of these things are going to end anytime soon. And then, of course, we have generally accepted accounting principles. So there's some principles that are pretty common. One is called the historical cost, and that basically is that when a company buys assets, they're recording it at what they bought it at. So even if a company bought a building in Manhattan in 1950 for $1 billion, and today it might be worth $100 million, we don't care, because we're measuring it in accounting. We're putting that building down at what we paid for it, what its cost was. It's $1 million on the books. Okay. We also have to be very, very careful to make sure that whether we are stating our assets and liabilities, that they are fairly valued, that we're not overvaluing or exaggerating the value of any of our assets or liabilities, because that is also part of the principles of GAAP. Okay. Full disclosure principles simply any circumstances and events that are happening to the company that are going to make a difference, right? To anyone who looks at and reads and uses those financial statements needs to be disclosed. But any type of disclosure has to be balanced with the cost of that. So if there's any information, the cost of providing certain information, if it really outweighs the benefit because it hasn't happened yet, that needs to be looked at. So you go back to Yogi Berra, it's not over till it's over. If a company's in a lawsuit and it looks like they're going to lose, should they disclose it? Should they actually say that it's going to cost them that? Well, maybe they need to disclose if they're in a lawsuit, but it's not over. They could lose, they could win, they could appeal. It could go on for years. So that's part of the cost constraint. And then do it. Exercise 3 simply is a laundry list of these concepts and what the definitions are and what they mean, which are no problem because you can look that up. So questions on that?